exactly. And we are going to look at something. I don't think I've looked at this idea. I've produced a lot of content in my 6 years here at Tasty Trade, and we're still running here with the futures content, small exchange in particular. I haven't looked at this idea in years. I know I've never looked at it since you joined the crew here, Jermal. The idea that we're tapping into today comes from a viewer, and I'm awful at this because I didn't look up his name prior to this segment, and so he deserves a shout out. He emailed me about this idea. I should try to find it. Anyways, Joe,
you should try to find it. You should try to find it.
Shout out. I think his name is Joseph Matthews. Shout out to him for giving us this idea. And I love all the emails and Twitter engagement from all of our audience out there. I'm Frank at Tasty Trade on email, Frank at tastytrade.com, Frank_Caberna on Twitter, Jermal Chandler. He's got similar credentials. You can find him. It's got to be Jermal at tastytrade.com on email. And then Jermal_, what's your Twitter handle?
At Jermal Chandler. Yeah. So it's easy, straight, all one word. I've always wondered about that with you. Why the underscore? Was there a different Frank Caberna?
So Frank Caberna, this is another whole, we're going to do 10 minutes on this now. My first name ends with the same letter as my last name, Frank Caberna. Okay. It's the two hard K sounds there. First of all, it's my parents. This is item number 1,000,000 on how they have not set me up for success, and anything that I have done unsuccessful in my life is their fault. But the name thing, Frank Caberna, you don't know how many times I've told people, oh, hi, I'm Frank Caberna. And they've said Frank O'Byrne or Frank Aberna because the K, it blends. And then also when you write it out, Frank, A-N-K, K-A-B-E-R-N-A, you don't know where one thing ends and the other's begins. It's a whole problem. So I threw the underscore in there. But this is all to say.
You're telling this story to a guy with the first name Jermal. Just remember that.
But at least that's like distinct and unique. My problem is the stuff like blends together like a sandwich. People can't ever find me. But if you do find us, always reach out with any questions that you have or anything. We love to field all that stuff. I mean, I was trying to answer some people even last night. That's great thing about this whole universe is we're here to help everyone out. And today we're helping out with the idea of delta hedging options with futures, because this came to mind with all of the movement we've been seeing in interest rates in particular. And this is an idea that is probably borrowed mainly from stocks, where it's like, oh, I've got options positions on in, say, the S&P 500, and my deltas are swaying day to day, right? Because the market is moving and I've got long or short options, and maybe I've got some kind of premium play. I'm long or short volatility, and I'd like to hedge every day or every couple of days those deltas as they come in and out of my account with something that's low cost and something that is a fractional amount of the product that I'm trading options on. And that's where the small exchange futures really come in spades. They're small, flexible, and most of them have a margin of just a couple $100. And so this idea came up with all the big movement in interest rates, Jermal. Joseph has a position on in the big ZB futures options, and he wanted to use our smaller product to hedge some of those deltas. What's your experience with delta hedging, any kind of options? Have you ever done it with shares or anything else?
Oh, most definitely. I mean, that's basically how I made a living. That's how I started in the business, working at a prop firm. That was basically the idea. You would trade your options, and we wouldn't necessarily always look at like the idea of straddle or strangle. Sometimes these particular puts are high, and so you just sell those puts and you sell stock against it. So 100%, majority of the time, the idea was hedge something with options. And even in that, if you have, say, a short stock, short put position, and the position is going against you, we were often advised to use options to hedge, to go ahead and hedge that volatility. So. Yeah.
And that's exactly a great example. And that's from, Jermal's days of professionally trading. I feel like that is the majority. Everybody likes to think like, ooh, like the Goldman Sachs or Morgan Stanley or these professional trading desks, that the people who are way up there in terms of like the highest zenith of professional trading, their day to day is usually like spreadsheets updating live that are like, oh, the market moved 1% lower. And so now our short volatility play on our healthcare basket of stocks is now we're long, 5,000 deltas, and we need to go in there and sell shares to counteract that. Or like you say, a much simpler way to view it is like, oh, volatility is high and there's put skew in this market. I want to sell the expensive options, but if I sell the puts, then I'm long deltas, and I don't want to be long the market, right? I just want to be short that volatility. And so I sell the puts and, like you say, sell the stock against it. And that is, a lot of the day-to-day of professional trading, but it's something that also is intriguing from the retail side because you get big movements in the market. Like to start off the year here, interest rates really taking the front page of everybody's trades because a huge move yesterday, biggest rally in months that we saw in 30-year yields, Jermal. And this uncoincidentally happened during the biggest decline in Treasury bonds in months. And that's because this is the same product here, ZB futures, the classic bond futures, the 30-year bond futures, the long bond futures, whatever you want to call them. As those bond prices move lower, you have the yield on that same exact product. It's the same underlying market, just a different representation. The yield moves higher. And this had to, even you as being majority stock guy, this interest rate move had to pique your interest, right?
Yeah, definitely. Yesterday you could see that long bond move, like you said, and also, the 10-year and even shorter durations moved. It was interesting that they were all up the way that they were. And so, it made things move, especially on the stock side of things. There's certain stocks that are sensitive. I guess I shouldn't just say certain. There's a lot of stocks that are sensitive to these rate moves. And so this was the story of the day yesterday, as you noted, for sure.
And so that's what leads a lot of people. And I love the idea that when interest rates take over or commodities take over, people should feel empowered. And this is part of the Small Exchange's mission, is bringing you smaller products. Hopefully you feel empowered to jump into those different markets. Now, there are always going to be some questions. And that's why we talk about, you can always hit us up with any of those questions, because our friend Joe went in there and decided, hey, there's a big move in this ZB market. And that's, it's a market that's been around for decades and where a lot of people go first, either ZB or ZN. Those are the CME Treasury bond and note futures in bond prices. We've just in the last year created the yield, which is the inverse of that. You can see from this chart, it's smaller and it reflects the percentage yield that you oftentimes hear quoted in Wall Street Journal and different places. They're the same underlying market, Jermal. There's no, it's not a matter of like this stock index, the NASDAQ has 100 stocks and it's tech focused. The S&P has 500 and it's got tech and it's also got financials in it. This is the same exact single market here. It's just one is the yield and the other is the price. And you can see here, there's not a day that you could point out a data point that one is moving up and the other isn't moving in the direct opposite direction.
Yeah, if we find that, something's really wrong. It would be a problem. Something's broken. You know what? And I'm glad you brought this up because I for years, unless you had a Bloomberg, you couldn't necessarily plot these. There weren't anything that really tracked these. There weren't anything, you had to have these specific products to be able to look at them, or you had to have like a Bloomberg or something like that. And this is like when I first learned to trade. And so this kind of gets to, luck, like our show that we did, The Leap, which was awesome, to be able to understand these relationships. This was always something I was confused about because people didn't always say, oh, this is the note or this is the yield. They just say bonds. Bonds are moving. Well, what does that mean? And we've talked about that before. So that's why it's so great that you have this here for those who might be learning or just beginning to understand. But honest question here, with a 30-year yield, it's pretty straightforward how our 30-year yield with the smalls, it's tracking 24. So this is really like 2%. What price does that represent for that ZB bond, for the long bond?
This is an interesting question. I'm glad that you brought that up because I think it's a nice aside. We've got a couple items still to get to, but it's a nice aside to kind of sit on here for a second, because I actually used to do this with our mutual friend, Peter Momet, when interest rates were getting close to 0%. And we didn't have the small exchange products because obviously if the 30-year yield was down at zero, you would see S30Y would just be zero. And so it's very easy now to kind of gauge those things. But we were trying to translate like what price would you have to get to in ZB futures to imply a zero interest rate. And so we did do that translation, and it's such a perfect relationship here that it is a matter of saying, okay, well, when 30-year yields on a day like today are right now around 2% or $20, and that is correlating to a price in ZB of around 157, 158. And so it's not a matter of, and I don't think you even want to try to do this math because I don't think it really gets you anywhere. But like, I don't have the formula to derive the yield from the price is intensive. And it's something I don't have offhand. I can't even do for you right here, but it's not something necessarily that I want anyways. It's a matter of just like knowing that buying S30Y at $20 is essentially the same as selling ZB around 157, 158, kind of where they are right now. And similar, you can do kind of a test here and see when 30-year yields got up to their highs of 2021 of $25, which is 2.5% in that yield, that correlated to a price in ZB of around 155, 154 down there at the lows. And so it's nice to kind of, you can look at the historical data for these two markets and not necessarily calculate or, like I'm saying, imply one from the other, but at least kind of look at certain data points and chart them accordingly.
Okay.
Now let's move on to delta hedging options positions in ZB with the futures, because I love where you went with this to start the show, because this is actually where we're going to go with our example, which is to say that like you see this downside move in ZB, and this to me smacks of like it's near the lows. Volatility is rising in this market. I think we've got IV ranks in ZB, north of 35, 40%, getting close to 50% and even higher. So highs in volatility for the last year or so. And I want to maybe look at selling a put into downside action and fear building and put skew also that I saw yesterday afternoon that I think is still present in the market. Now, I want to sell the puts, Jermal, but maybe I don't necessarily want the deltas that are saying, bonds have to move higher and thus yields have to move lower. Maybe I'm kind of neutral on this market. How can I construct a strategy using these two different products? Well, first, you're going to want to compare them to see how much smaller S30Y is to begin with. And it's a great starting place, the 30Y, the 10Y, and the 2Y. For anyone trying to get into yields or get into futures in general, you can see $2,000 size with a margin of $400. You can trade your assumptions on yields back and forth very effectively relative to the large ZB futures. I mean, when I put those numbers out there, do those scare you off at all, Jermal?
I mean, I guess a little bit. Yeah, initially, right? I mean, just going with even, what I knew before I even came to learning to trade any yields or anything. Yeah, for sure. It's a daunting task, 4,800 compared to 400.
And also just, I know that this isn't like real risk when you say like, we're going to look at selling a put here in ZB at maybe, let's call it the 150 strike. And that would mean that we have downside risk theoretically of $150,000. Like that's of course, like I say, that's not really real. The bond price isn't going to go to zero. It never has, and it likely won't. But that's still, it is, like you say, daunting. It's like, man, that's a big fat risk in there. And the margin is, and this is a great way to kind of see how much S30Y should I be doing for a delta in ZB. I always just compare the margins, and you can see here that the margin of the larger ZB, about $4,800, very evenly sliced into the $400 margin. S30Y getting you about 1/12. We can round it off to 1/10 or whatever you want to do. This stuff is all imperfect, as you'll see, as anybody who's traded options or futures before sees. The deltas move literally continuously, and so you're never going to get a perfect hedge anyway, but about 1/12. Now let's build our core strategy here, which was selling volatility in bonds. Bond market's moving lower. Volatility and option prices moving higher, Jermal. And the skew is to the downside. Now, say I just want to sell your basic 150 put. I don't think the market's going to get down there. And there's nice premium in there. I mean, this is you in engineering the trade on your show. All of those assumptions kind of lead into this basic strategy, right?
For sure. Yeah, absolutely. Bond prices going down. You're interested in this idea. So selling a little downside put there.
But the thing is with me, and me particularly, and I think our viewer Joe was speaking to, which is like, I want to sell the put because it's expensive and all these different reasons. I don't think bonds will get down to 150. They haven't been there in the last year plus. This is actually data going back to 2020. Haven't been there in the last 2 years. And so we've got a lot of stuff going for us. But if I sell that 150 put, Jermal, then I'm long, I believe it's 10 deltas in ZB. And so maybe I don't want to necessarily be long deltas in ZB and thus short in the yield market. Maybe I want to be neutral, or even like I want to sell that put, but I maybe even still have a bias to the upside in yields and downside in ZB, but I just want to sell that big fat premium. Well, you can delta hedge in the small futures very, very easily. You can sell that 150 put in ZB, and rounding the S30Y contract off to about 5 deltas here, you could look at the fact that one S30Y is negative 5 deltas in ZB. So if I sell the 10 delta put in ZB, I'm long 10 deltas. And thus I can counteract that with 2 long S30Y contracts. I know it's wonky with the negative correlation, but is that all kind of making sense?
Big time. I mean, I totally get it. And I think what you've done is magnificent here. And I think we should just hammer it home one more time, even though you said it, you absolutely said it, but I know how it goes. I remember what it was learning these type of things. Let's hammer it home for people to get, because if we're selling the 150 put in ZB, normally you would just hedge with ZB being short ZB, right? But like you said, we're getting long 230Y contracts, 2S30Y contracts, because it's inverse. So people understand that.
Exactly right. And, the question becomes, oh, well, why don't I do this in ZB? Well, the contract size is very big there. Oh, well, why don't I get in there and sell the calls? Well, because there's put skew in this market. I don't want to be selling cheap calls and deal with all of that mess there. And since the deltas are dynamic here, if the market does move higher or lower, hedging options with options, hedging something that's dynamic with something that's dynamic, I mean, that stuff literally changes every second. It becomes kind of a mess. Here, what's really nice is I can sell the 150 put in ZB, Jermal. I'm long 10 deltas in ZB. How do I counteract that? Well, I have my nice handy dandy ratio here, whereby one long contract is negative 5 ZB deltas. And so I'm long 10 ZB deltas. I can buy 2 of these. That gets me to negative 10 ZB deltas. I'm at a wash. I'm neutral right now. Now, tomorrow, maybe ZB falls another point, and now I'm long another 5 deltas, or it falls 2 points. I'm long another 10 deltas, or whatever the numbers are there. Well, I just buy 1 more S30Y, or I buy 2 more S30Ys in accordance with every 5 delta chunk that I get longer in ZB. The market maybe bounces back. ZB bounces back tomorrow, Jermal, and now I'm actually I've delta hedged too much. I'm only long 5 deltas in ZB, and I've got 2 long S30Y contracts on. Well, I pull one of those off, and now I'm back to neutral. And that is, I mean, maybe you can send us out with this. I mean, that was the day-to-day of professionally trading and delta hedging from your point of view as a pro, right?
Absolutely. What was the day-to-day? Like you said, the idea of delta hedging or dynamically hedging, as you so eloquently explained, like how it's moving around and you're constantly having to hedge and re-hedge. Well done, Frank. Nice work.
Yeah, it's
nice work, Joe Matthews, man. Nice work for asking for this.
Yeah, absolutely. Great high level question from our viewer out there. And it's one that I'm happy to answer and happy to talk about, because we rarely look at stuff like that. But when volatility spikes, especially in a market that you're like, I don't really know if the thing's moving higher or lower, I don't want to sell the strangle or the iron condor because that'll get out of whack. Just looking for the skewed side, or looking for the most expensive options, and then delta hedging along the way to make sure that like the last thing you want, Jermal, and I know you know this feeling of like, oh, I sold the expensive options last week. The market moved around and now I'm long a ton of Netflix. And it's like, I didn't want to be long Netflix. What the hell is going on here? And so delta hedging along the way can really get rid of all of that directional bias and just at the end of the day, hopefully you're just making money on volatility coming in or coming out, you know?
Yeah, absolutely, man. That's a great one. I like that. Nice little trade there.
Cool, man. Well, thanks so much for joining us and lending us your experience of delta hedging with stock and everything else. The stuff translates directly here. Thankfully, now you've got those small exchange products that dice things up and let you hedge the bigger options positions in your portfolio. But we do have some trades to get on here. Always a joy Tuesday with Jermal Chandler here. Go follow him on Twitter and watch Engineering the Trade on the Tasty Trade Network. Next up, we got Splash into Futures with Peter Momat. We got a bunch of movement in futures markets, continuing higher in some of the yield markets. Equities are all over the place. Is tech over with? Who knows? We're going to get a bunch of trades going with Peter Momat next. Everybody hang in for that. Splash into Futures. Thanks for watching. Peace.